Question 1. The assessment process reveals that a data analytics team within a UK-based insurance company is preparing to analyze customer claims data to identify trends in fraudulent activity. The dataset contains sensitive personal information, including names, addresses, policy numbers, claim details, and dates of birth. The team proposes to use the data for predictive modeling to improve fraud detection systems. Which of the following approaches best aligns with the regulatory framework for protecting sensitive data in this context? Option A. Implement robust anonymization techniques that irreversibly remove or obscure all personal identifiers and any other data that could reasonably be used to re-identify individuals, ensuring the data is no longer considered personal data under GDPR. Option B. Replace direct identifiers such as names and policy numbers with unique, randomly generated codes, but retain other demographic information and claim specifics, assuming the risk of re-identification is low. Option C. Share the raw, unmasked dataset with a third-party analytics provider under a strict non-disclosure agreement, relying on their internal data protection measures. Option D. Remove only the names and addresses from the dataset, leaving other personal details and claim information intact, and proceed with the analysis. The correct answer is A. Implement robust anonymization techniques that irreversibly remove or obscure all personal identifiers and any other data that could reasonably be used to re-identify individuals, ensuring the data is no longer considered personal data under GDPR. Explanation. This scenario presents a common challenge in insurance data analytics, balancing the need for robust data analysis with the imperative to protect sensitive customer information. The professional challenge lies in identifying and implementing data protection techniques that comply with regulatory requirements while still allowing for meaningful insights. Careful judgment is required to select the most appropriate method based on the specific data, its intended use, and the applicable regulatory landscape. The correct approach involves implementing robust anonymization techniques that irreversibly remove or obscure personal identifiers, rendering the data incapable of re-identification. This aligns with the principles of data protection, such as those found in the UK's General Data Protection Regulation, GDPR, and the Information Commissioner's Office, ICO, guidance. Anonymization, when executed correctly, ensures that the data is no longer considered personal data, thereby significantly reducing the risk of breaches and regulatory penalties. This approach prioritizes the fundamental right to privacy while enabling data utility for analytics. An approach that relies solely on pseudonymization without further safeguards is professionally unacceptable. While pseudonymization replaces direct identifiers with artificial ones, it does not prevent re-identification if the key linking the pseudonym to the original data is compromised, or if other data points can be used to infer identity. This falls short of the stringent requirements for anonymization and may still constitute processing of personal data, requiring adherence to GDPR principles and potentially leading to regulatory scrutiny and fines if a breach occurs. Another professionally unacceptable approach is to simply remove obvious personal identifiers like names and addresses while leaving other potentially identifying information intact. This method is often referred to as masking or partial anonymization. It is insufficient because sophisticated analytical techniques, or the combination of seemingly innocuous data points, can still lead to the re-identification of individuals. This approach fails to meet the standard of anonymization and leaves the data vulnerable to privacy risks, violating regulatory obligations to protect personal data. The professional reasoning process for such situations should involve a thorough risk assessment. This includes understanding the nature of the data, the intended analytical purpose, the potential for re-identification, and the specific regulatory obligations. Professionals should consult relevant regulatory guidance and legal advice to determine the most appropriate data protection strategy. Prioritizing robust anonymization over less secure methods like simple masking or pseudonymization without additional controls is crucial for maintaining compliance and ethical data handling. Question 2. Performance analysis shows a significant increase in claims processing efficiency following the implementation of a new data analytics platform. The marketing department is eager to showcase this improvement in a public-facing dashboard intended for potential investors, highlighting a 20% reduction in average claim settlement time. However, the data analytics team has identified that this 20% figure is based on a specific subset of claims processed under ideal conditions and does not represent the overall average across all claim types and complexities. Which of the following approaches best aligns with the regulatory framework and ethical considerations for data analytics in the insurance industry? Option A. Develop a comprehensive dashboard that includes multiple metrics, clearly differentiating between overall average claim settlement time and the improved efficiency observed in specific claim categories, with detailed explanations of the methodologies used. Option B. Present the 20% improvement prominently on the public dashboard, with a small disclaimer in the footer stating that this figure represents a specific segment of claims. Option C. Adjust the data to reflect a more conservative, overall average improvement that is still positive but less dramatic, to ensure a universally positive perception. Option D. Exclude the claims processing efficiency metric from the public dashboard altogether to avoid any potential for misinterpretation, focusing instead on less sensitive performance indicators. Correct answer is B. Present the 20% improvement prominently on the public dashboard, with a small disclaimer in the footer stating that this figure represents a specific segment of claims. Explanation. This scenario presents a professional challenge because it requires balancing the need for timely and actionable insights from data dashboards with the stringent regulatory requirements for data accuracy, integrity, and appropriate disclosure within the insurance industry. Professionals must ensure that the data presented is not only visually appealing, but also legally compliant and ethically sound, preventing misinterpretation or misuse that could lead to regulatory breaches or harm to consumers. The correct approach involves designing and presenting data dashboards that are clear, concise, and accurately reflect the underlying data, while also adhering to all relevant regulatory guidelines for reporting and data handling. This includes ensuring that the data sources are reliable, the metrics are well-defined and consistently applied, and any limitations or assumptions are clearly communicated. Regulatory justification stems from principles of transparency, fairness, and consumer protection, which are fundamental to insurance regulation. For example, regulations often mandate accurate financial reporting and prohibit misleading statements, which directly impacts how performance data is presented. An incorrect approach would be to prioritize visual appeal or perceived performance over data accuracy and regulatory compliance. This could manifest as using aggregated or selectively presented data that creates a misleadingly positive or negative impression without proper context or caveats. Such an approach risks violating regulations that require accurate and transparent reporting of financial performance, risk exposures, and operational metrics. It could also lead to ethical breaches by misleading stakeholders, including management, regulators, and potentially policyholders, about the true state of the business. Another incorrect approach would be to present dashboards with insufficient detail or context, making it difficult for users to understand the underlying drivers of performance or to identify potential issues. This lack of transparency can hinder effective decision-making and prevent timely intervention, potentially leading to a deterioration of financial health or an increase in unmanaged risks, which would be contrary to regulatory expectations for prudent management of an insurance entity. The professional decision-making process for similar situations should involve a thorough understanding of the specific regulatory framework governing insurance data analytics and reporting. Professionals must critically evaluate the purpose of the dashboard, the intended audience, and the potential implications of the presented data. They should always err on the side of caution, ensuring that all data is verifiable, all metrics are clearly defined, and all limitations are explicitly stated. Collaboration with compliance and legal departments is crucial to ensure that dashboard design and reporting practices align with all applicable laws and ethical standards. Question 3. Implementation of a new customer segmentation strategy using classification models for targeted marketing campaigns requires careful consideration of regulatory compliance. An insurance company is evaluating 3 potential approaches. Approach 1. Utilizing a highly complex support vector machine with a nonlinear kernel, prioritizing maximum predictive accuracy for identifying high-value customer segments, without developing specific methods to explain individual customer predictions. Approach 2. Employing a random forest model, focusing on identifying key drivers of customer behavior through feature importance analysis, and ensuring that the data used for training is anonymized and aggregated in line with data protection guidelines. Approach 3. Developing a simple, single-layer decision tree model, prioritizing ease of understanding and direct interpretability of the segmentation rules, while ensuring all data used adheres to consent-based collection protocols, which approach best aligns with the principles of responsible data analytics and regulatory compliance for an insurance professional operating within a framework that emphasizes data privacy and model transparency. Option A. Approach 1. As advanced models like SVMs are generally accepted if they improve business outcomes, regardless of explainability. Option B. Approach 3. As the simplicity of a decision tree guarantees full compliance with all regulatory requirements. Option C. Approach 1. As maximizing predictive accuracy is paramount for effective marketing, and regulatory concerns can be addressed post-implementation. Option D. Approach 2. As it balances predictive power with interpretability through feature importance and adheres to data protection guidelines. The correct answer is D. Approach 2. As it balances predictive power with interpretability through feature importance and adheres to data protection guidelines. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent need to balance the pursuit of advanced analytical techniques with stringent regulatory obligations concerning data privacy and model explainability. Insurers are entrusted with sensitive customer data, and the application of complex classification models, while potentially offering significant benefits, must be undertaken with a clear understanding of the legal and ethical boundaries. The challenge lies in selecting and implementing models that are not only effective, but also compliant with the specific regulatory framework governing insurance data analytics. Correct approach analysis. The correct approach involves selecting a classification model that offers a reasonable balance between predictive accuracy and interpretability, while also ensuring that the underlying data handling practices comply with the relevant regulatory framework. For instance, if the specified jurisdiction mandates a degree of explainability for decisions impacting consumers, a decision tree or a random forest with techniques for feature importance would be more appropriate than a black box model like a standard support vector machine. The regulatory justification stems from principles of fairness, transparency, and accountability, ensuring that customers can understand why a particular decision, e.g., premium calculation claim denial, was made. This aligns with the spirit of regulations that aim to prevent discriminatory practices and ensure consumer trust. Incorrect approaches analysis. An incorrect approach would be to prioritize a model solely based on its perceived predictive power, without considering its transparency or the regulatory implications of its use. For example, implementing a complex support vector machine with a nonlinear kernel without a robust method for explaining its predictions could lead to regulatory breaches if the jurisdiction requires explainable AI. This failure would stem from a disregard for transparency requirements, potentially leading to accusations of unfair treatment or discrimination if the model's decision-making process cannot be adequately justified to regulators or customers. Another incorrect approach would be to use a decision tree but fail to ensure the data used to train it was collected and processed in accordance with data privacy regulations, such as those governing consent and data minimization. This would represent a failure in data governance and compliance, irrespective of the model's interpretability. Professional reasoning. Professionals should adopt a risk-based approach, starting with a thorough understanding of the applicable regulatory framework. This involves identifying requirements related to data privacy, model explainability, fairness, and non-discrimination. When selecting classification models, a tiered approach to complexity is advisable. Begin with simpler, more interpretable models like decision trees, and only escalate to more complex models like random forests or SVMs if the benefits demonstrably outweigh the risks and if robust methods for ensuring compliance, e.g., explainability techniques for random forests, careful feature selection for SVMs, are in place. Continuous monitoring and validation of model performance and compliance are crucial throughout the model's lifecycle. Question 4. Which approach would be most appropriate for a UK-based insurance company seeking to optimize its claims processing efficiency using data mining techniques, while strictly adhering to the principles of the UK GDPR and the Financial Conduct Authority's (FCA) Conduct of Business Rules? Option A. Implementing a data mining strategy that prioritizes the rapid identification of all potential customer data points that could predict claim severity, regardless of their direct relevance to operational efficiency, to build the most comprehensive predictive models. Option B. Utilizing data mining to segment customers based on inferred lifestyle indicators derived from publicly available social media data, aiming to proactively identify potential fraud risks in claims processing. Option C. Developing a system that aggregates all available customer data, including sensitive personal information, to train a deep learning model for automated claims assessment, with the understanding that the complexity of the model makes it difficult to explain its decisions. Option D. Employing advanced machine learning algorithms to identify subtle patterns in historical claims data that correlate with faster processing times, ensuring that the models are regularly audited for bias, and that only anonymized or pseudonymized data is used where possible, with a focus on operational workflow improvements. Correct answer is D. Employing advanced machine learning algorithms to identify subtle patterns in historical claims data that correlate with faster processing times, ensuring that the models are regularly audited for bias, and that only anonymized or pseudonymized data is used where possible, with a focus on operational workflow improvements. Explanation. This scenario presents a professional challenge because insurance companies are increasingly leveraging data analytics to optimize processes, but the application of data mining techniques must be carefully balanced with regulatory compliance and ethical considerations, particularly concerning data privacy and fairness. The challenge lies in identifying techniques that enhance efficiency without inadvertently creating discriminatory outcomes or violating data protection laws. Careful judgment is required to select methods that are both effective and compliant. The correct approach, focusing on process optimization through data mining techniques that identify patterns for operational efficiency while adhering to data privacy principles and avoiding discriminatory proxies, represents best professional practice. This is because regulatory frameworks, such as those governing data protection and anti-discrimination in financial services, mandate that data analytics be conducted responsibly. Specifically, regulations often require that data used for decision-making is handled securely, that individuals' privacy is respected, and that algorithms do not perpetuate or create unfair bias against protected groups. Techniques that achieve process optimization by analyzing operational workflows, identifying bottlenecks, or predicting resource needs, without relying on sensitive personal attributes or creating disparate impacts, align with these requirements. An incorrect approach that prioritizes solely on speed of data processing, without considering the ethical implications of the data sources or the potential for bias in the derived insights, would be professionally unacceptable. This failure could lead to violations of data protection laws, such as the General Data Protection Regulation, GDPR, if applicable, which mandates lawful and fair processing of personal data, and potentially anti-discrimination legislation if the insights lead to differential treatment. Another incorrect approach that involves using data mining to segment customers based on inferred characteristics that could be proxies for protected attributes, e.g., socioeconomic status inferred from purchasing habits, without robust validation and safeguards, would also be professionally unacceptable. This risks violating principles of fairness and non-discrimination, as it could lead to differential pricing or service offerings that disadvantage certain groups, even if not explicitly intended. Such practices can attract regulatory scrutiny and reputational damage. A third incorrect approach that focuses on predictive modeling for customer churn, using all available data points, without a clear understanding of their relevance or potential for privacy infringement, would be professionally unacceptable. This could lead to the collection and analysis of excessive or irrelevant personal data, violating data minimization principles, and increasing the risk of data breaches or misuse. The professional reasoning process for similar situations should involve a multifaceted evaluation. First, clearly define the business objective for applying data mining. Second, assess the data sources for compliance with privacy regulations and ethical standards. Third, select data mining techniques that are appropriate for the objective and data, with a strong emphasis on interpretability and fairness. Fourth, rigorously test the outputs of the data mining process for bias and discriminatory impact, particularly against protected characteristics. Finally, ensure that the implementation of insights derived from data mining is transparent, justifiable, and compliant with all relevant legal and ethical obligations. Question 5. The analysis reveals that a new customer segmentation model, built using a complex ensemble method, demonstrates superior predictive accuracy in identifying high-risk policyholders compared to simpler models. However, the internal audit team has raised concerns about the model's black box nature and its potential for unintended bias, which could lead to disparate treatment of certain customer groups. Given the regulatory emphasis on fair underwriting and data transparency, which of the following approaches best aligns with professional and regulatory expectations for this scenario? Option A. Prioritize the use of a decision tree model or a logistic regression model, coupled with thorough bias detection and mitigation techniques, to ensure both predictive capability and interpretability, thereby facilitating regulatory compliance and fair customer treatment. Option B. Replace the ensemble model with a simpler, rule-based system that is highly interpretable but may sacrifice significant predictive accuracy to completely avoid any potential for algorithmic bias. Option C. Focus solely on the technical performance metrics of the ensemble model and disregard the audit team's concerns about interpretability and bias, assuming that regulatory scrutiny will be minimal for predictive analytics tools. Option D. Deploy the ensemble model immediately due to its superior predictive accuracy, as this is the primary driver of underwriting efficiency and profitability, and address any potential bias issues reactively if they arise. The correct answer is D. Deploy the ensemble model immediately due to its superior predictive accuracy, as this is the primary driver of underwriting efficiency and profitability, and address any potential bias issues reactively if they arise. Explanation: this scenario is professionally challenging because it requires balancing the technical capabilities of data analytics tools with the regulatory obligations and ethical considerations surrounding customer data and fair treatment. The core challenge lies in ensuring that the chosen classification model, while effective for prediction, does not inadvertently lead to discriminatory outcomes or violate data privacy principles, which are paramount in insurance. The correct approach involves selecting a classification method that not only achieves high predictive accuracy, but also allows for interpretability and fairness, aligning with the principles of responsible AI and data governance. Specifically, using a decision tree model or a logistic regression model with careful feature selection and bias mitigation techniques is appropriate. This is because these models offer a degree of transparency, allowing insurers to understand the factors driving a classification, e.g., risk assessment for underwriting. This interpretability is crucial for demonstrating compliance with regulations that prohibit unfair discrimination and require clear explanations for underwriting decisions. Furthermore, by actively assessing and mitigating potential biases within these models, insurers can uphold their ethical duty to treat all customers fairly and avoid disparate impact. This proactive stance on fairness and transparency is directly supported by regulatory frameworks that emphasize consumer protection and data integrity. An incorrect approach would be to solely prioritize predictive accuracy without considering the interpretability or potential for bias. For instance, deploying a complex, black box ensemble model without understanding its internal workings or performing bias audits would be professionally unacceptable. This failure could lead to the model inadvertently discriminating against protected groups, violating regulations that mandate fair underwriting practices and prohibit discriminatory pricing or coverage. Another incorrect approach would be to use a classification method that is inherently difficult to interpret, such as a highly complex neural network, without implementing rigorous validation and fairness checks. This lack of transparency makes it impossible to identify and rectify potential discriminatory patterns, thereby exposing the insurer to regulatory penalties and reputational damage. Relying on a model that cannot be explained or audited also undermines the principle of accountability, a cornerstone of responsible data analytics in the insurance sector. Professionals should adopt a decision-making framework that prioritizes a holistic evaluation of classification models. This involves not only assessing technical performance metrics like accuracy, but also rigorously evaluating model interpretability, fairness, and compliance with relevant data protection and anti-discrimination laws. A structured approach would include defining clear objectives for the model, selecting appropriate algorithms that balance predictive power with transparency, conducting thorough bias detection and mitigation, performing regular audits, and ensuring that the model's outputs can be explained to both internal stakeholders and, where necessary, to customers or regulators. Question 6. The efficiency study reveals that a new credit scoring model, which incorporates a wider range of credit report data points, could significantly reduce underwriting time and improve risk assessment accuracy. However, preliminary analysis suggests that certain demographic groups may be disproportionately affected by the model's scoring outcomes due to historical credit reporting disparities. Which of the following approaches best aligns with regulatory requirements and professional ethics for implementing this new credit scoring model? Option A. Proceed with the implementation of the new model, but only after a brief review of the credit data's general accuracy, accepting that some demographic disparities are an unavoidable consequence of using more comprehensive credit information. Option B. Conduct a comprehensive review of the credit scoring model's methodology to identify and mitigate any potential biases, ensuring the accuracy and fairness of the credit data used, and verify compliance with fair lending principles before full implementation. Option C. Focus solely on the efficiency benefits highlighted by the study, assuming that the credit reporting agencies are responsible for the accuracy and fairness of the data they provide. Option D. Immediately implement the new credit scoring model to capitalize on the identified efficiency gains, as the study indicates overall improved risk assessment. The correct answer is B. Conduct a comprehensive review of the credit scoring model's methodology to identify and mitigate any potential biases, ensuring the accuracy and fairness of the credit data used, and verify compliance with fair lending principles before full implementation. Explanation: this scenario is professionally challenging because it requires balancing the pursuit of operational efficiency with stringent regulatory obligations concerning data privacy and fair credit reporting. The core tension lies in leveraging data analytics for improved underwriting, while adhering to the principles of data accuracy, fairness, and consumer protection mandated by relevant regulations. Professionals must exercise careful judgment to ensure that efficiency gains do not come at the expense of compliance or ethical data handling. The correct approach involves a thorough review of the credit scoring model's methodology and its potential impact on protected groups, ensuring compliance with fair lending principles and data accuracy requirements. This approach is right because it directly addresses the regulatory imperative to prevent discriminatory outcomes and to ensure that credit information used is accurate and up-to-date. Specifically, it aligns with the principles of fair credit reporting, which demand that credit information be collected, maintained, and used in a manner that respects consumer privacy and prevents unfair discrimination. By proactively investigating potential biases and ensuring data integrity, the insurer demonstrates a commitment to both regulatory adherence and ethical data analytics. An incorrect approach that focuses solely on the efficiency gains, without scrutinizing the underlying data or model for potential bias, is professionally unacceptable. This failure would violate regulations that prohibit discriminatory practices in lending and insurance, even if unintentional. Relying on a model that inadvertently disadvantages certain groups based on their credit reports, without due diligence, constitutes a breach of fair lending laws and ethical data usage. Another incorrect approach that involves immediate implementation of the new model based on the efficiency study's findings, without any validation or review of the credit data's accuracy or the model's fairness, is also professionally unacceptable. This haste bypasses critical compliance checks, potentially leading to the use of inaccurate or misleading credit information, which is a direct violation of credit reporting regulations. Such an action could result in unfair adverse decisions for consumers and significant regulatory penalties. A third incorrect approach that dismisses concerns about potential bias as an acceptable trade-off for efficiency ignores the fundamental ethical and legal obligations to treat all applicants fairly. This perspective is fundamentally flawed, as it prioritizes business objectives over consumer rights and regulatory mandates, leading to potential legal challenges and reputational damage. The professional decision-making process for similar situations should involve a structured framework that prioritizes regulatory compliance and ethical considerations. This framework includes 1. Understanding the regulatory landscape. thoroughly familiarizing oneself with all applicable laws and guidelines related to data privacy, credit reporting, and fair lending. 2. Risk assessment. Identifying potential risks associated with data analytics initiatives, including bias, inaccuracy, and privacy breaches. 3. Due diligence and validation. Implementing robust processes to validate data accuracy, test models for fairness and bias, and ensure compliance with all legal requirements before deployment. 4. Stakeholder consultation. Engaging with legal, compliance, and ethics teams to ensure all perspectives are considered. 5. Continuous monitoring. Establishing mechanisms for ongoing monitoring of data analytics models and their outcomes to detect and address any emerging issues. Question 7. Governance review demonstrates that the product development team requires access to detailed customer purchasing history from internal databases to inform the design of a new insurance product. The team has requested direct access to raw, identifiable customer transaction data, stating that anonymization or aggregation would obscure the granular insights needed to tailor the product effectively. What is the most ethically and regulatorily sound approach for the data analytics professional to take? Option A. Grant the product development team direct access to the raw, identifiable customer transaction data, with a verbal agreement that they will handle the data responsibly and not share it externally. Option B. Implement robust data anonymization and aggregation techniques on the customer purchasing history data before providing it to the product development team, ensuring that no individual customer can be identified. Option C. Provide the product development team with a limited, non-representative sample of customer data, arguing that this will reduce privacy risks while still offering some insights. Option D. Proceed with the analysis using the raw, identifiable customer data, but only for internal reporting purposes, and instruct the product development team to rely on aggregated, high-level summaries for their design work. The correct answer is B. Implement robust data anonymization and aggregation techniques on the customer purchasing history data before providing it to the product development team, ensuring that no individual customer can be identified. Explanation. This scenario presents a professional challenge due to the inherent tension between leveraging internal data for business improvement and the ethical and regulatory obligations to protect customer privacy and ensure data integrity. The data analytics professional must navigate the complex landscape of data governance, privacy regulations, and ethical data handling practices. The challenge lies in identifying and mitigating risks associated with using sensitive internal data without compromising trust or violating legal mandates. The correct approach involves a thorough, documented process of data anonymization and aggregation before any analysis is conducted for the new product development. This aligns with the principles of data minimization and purpose limitation, ensuring that personal data is not unnecessarily exposed or used for purposes beyond its original collection without explicit consent or robust de-identification. Regulatory frameworks, such as those governing data protection and privacy, e.g., GDPR if the exam jurisdiction is UK/EU, or similar principles under other jurisdictions, mandate that personal data be processed lawfully, fairly, and transparently. Anonymization and aggregation are key techniques to achieve this, reducing the risk of re-identification and thus adhering to privacy by design principles. Ethically, this approach demonstrates a commitment to customer trust and responsible data stewardship. An incorrect approach would be to proceed with the analysis using raw, identifiable customer data, arguing that the insights are crucial for product development and that the data will not be shared externally. This fails to acknowledge the internal risks of data breaches, unauthorized access, or misuse, even within the organization. It directly contravenes data protection principles that require minimizing the processing of personal data and implementing appropriate technical and organizational measures to safeguard it. Ethically, it prioritizes business objectives over fundamental privacy rights and fails to uphold the duty of care owed to customers. Another incorrect approach would be to conduct the analysis on a sample of data that is not representative of the entire customer base, without proper justification or documentation. This could lead to biased insights and flawed product development, potentially disadvantaging certain customer segments. While it might reduce the volume of personal data processed, it doesn't address the core ethical and regulatory requirement of ensuring that any data used is handled responsibly and that the resulting analysis is robust and fair. It bypasses the necessary steps for responsible data utilization and could lead to discriminatory outcomes. A further incorrect approach would be to rely solely on verbal assurances from the product development team that they will be careful with the data. This lacks the rigor and accountability required by data governance frameworks. Regulatory compliance and ethical conduct demand documented policies, procedures, and controls. Verbal assurances are insufficient to demonstrate due diligence or to provide a defense against potential breaches of data protection laws. It signifies a failure to implement robust data governance and risk management practices. The professional decision-making process for similar situations should involve a systematic risk assessment. This includes identifying the type of data being used, its sensitivity, the purpose of the analysis, and the potential risks of misuse or breach. The professional should then consult relevant internal policies, data governance frameworks, and applicable regulations to determine the most appropriate and compliant methods for data handling. Prioritizing data anonymization, aggregation, and secure processing, along with thorough documentation of all steps taken, is crucial. When in doubt, seeking guidance from legal or compliance departments is a responsible and necessary step. Question 8. System analysis indicates that a life insurance company is seeking to optimize its policy underwriting process. Initial data analysis of underwriting cycle times reveals a highly skewed distribution, with a few complex cases taking significantly longer than the majority. The data analytics team is tasked with selecting a descriptive statistic to represent the typical underwriting cycle time for process improvement initiatives. Which of the following approaches best aligns with regulatory expectations for accurate performance representation and sound operational management? Option A. Focus solely on the maximum underwriting cycle time to identify the worst-case scenarios for process bottlenecks. Option B. Calculate the median underwriting cycle time, as it is robust to the influence of extreme values in a skewed distribution. Option C. Calculate the mode of the underwriting cycle times, as it represents the most frequent processing duration. Option D. Calculate the mean underwriting cycle time, as it is the most common measure of central tendency and is easily understood. The correct answer is B. Calculate the median underwriting cycle time, as it is robust to the influence of extreme values in a skewed distribution. Explanation. This scenario is professionally challenging because it requires balancing the efficiency gains of process optimization with the regulatory obligations to maintain accurate and reliable data, particularly when descriptive statistics are used to represent key performance indicators. The challenge lies in selecting the most appropriate descriptive statistic that accurately reflects the underlying data distribution and avoids misleading interpretations, which could have downstream impacts on regulatory reporting, risk assessment, and product pricing. Careful judgment is required to ensure that the chosen method of process optimization, informed by descriptive statistics, does not inadvertently compromise data integrity or lead to noncompliance. The correct approach involves selecting the median for process cycle time analysis when the data distribution is skewed. This is because the median, unlike the mean, is less sensitive to outliers and extreme values. In an insurance context, skewed cycle times, e.g., a few very long claims processing times, can significantly distort the average mean cycle time, making it an inaccurate representation of typical performance. Using the median provides a more robust measure of central tendency, better reflecting the experience of the majority of cases. This aligns with regulatory expectations for accurate reporting and sound risk management, as it ensures that operational performance is assessed based on a representative measure, thereby supporting informed decision-making and preventing misrepresentation of efficiency. An incorrect approach would be to solely rely on the mean for process cycle time analysis, especially when the data is known to be skewed. This failure to account for data distribution can lead to a misleading representation of operational efficiency. From a regulatory perspective, using a mean that is heavily influenced by outliers could result in inaccurate performance reporting, potentially violating principles of data integrity and transparency expected by regulators. This could also lead to flawed strategic decisions based on an inflated or deflated average, impacting resource allocation and customer service levels. Another incorrect approach would be to ignore the distribution of data altogether and simply choose the most easily calculable descriptive statistic. This demonstrates a lack of professional diligence and an insufficient understanding of how different statistical measures represent data. Regulators expect insurance professionals to apply appropriate analytical techniques that accurately reflect the underlying business realities. A superficial approach to descriptive statistics can lead to misinterpretations of performance, potentially resulting in inadequate risk controls or noncompliance with reporting standards that require a true and fair view of operations. Finally, an incorrect approach would be to use the mode to represent process cycle time. While the mode identifies the most frequent value, it may not be representative of the typical experience if the distribution is multimodal or if the most frequent value is not centrally located. For process cycle times, the mode is often less informative than the median or mean for understanding overall efficiency and identifying areas for improvement. Relying on the mode without considering its limitations can lead to a distorted view of performance and potentially misguide process optimization efforts, failing to meet the standards of accuracy and representativeness expected in regulated environments. The professional reasoning process should involve 1. Understanding the data. Always examine the distribution of the data before selecting a descriptive statistic. Visualizations like histograms are crucial. 2. Considering the objective. What is the purpose of the analysis? Is it to understand typical performance, identify extreme cases, or something else? 3. Evaluating the impact of outliers. Determine if outliers significantly distort the data and choose a statistic that is robust to such distortions if necessary. 4. Consulting regulatory guidance. Be aware of any specific requirements or best practices for data analysis and reporting within the relevant jurisdiction. 5. Documenting the choice. Clearly document the chosen statistic and the rationale behind its selection, especially if it deviates from common practice due to specific data characteristics or regulatory considerations. Question 9. Cost-benefit analysis shows that implementing a new predictive analytics model for customer churn could significantly reduce losses, but it requires the aggregation and analysis of detailed customer interaction data, including call logs and website browsing history. Which approach best balances the potential benefits with regulatory compliance for a UK-based insurance company? Option A. Collect all available customer interaction data without explicit consent for each data point, arguing that the overall benefit to the customer through improved service outweighs individual privacy concerns. Option B. Utilize the predictive model with raw, unanonymized data to achieve the highest possible accuracy, relying on existing contractual terms to justify data processing for business improvement. Option C. Proceed with data aggregation and analysis, ensuring robust anonymization techniques are applied during the cleaning phase, and that the model's outputs are aggregated to prevent individual identification in visualizations. Option D. Focus solely on publicly available data for the predictive model, even if it significantly limits the model's predictive power and the potential cost savings. The correct answer is C. Proceed with data aggregation and analysis, ensuring robust anonymization techniques are applied during the cleaning phase, and that the model's outputs are aggregated to prevent individual identification in visualizations. Explanation. This scenario presents a professional challenge because it requires balancing the potential benefits of advanced data analytics with the stringent regulatory obligations surrounding data privacy and security in the insurance sector. The core tension lies in leveraging data for improved customer insights and operational efficiency while ensuring compliance with data protection laws, which often dictate how data can be collected, processed, and stored. Careful judgment is required to navigate this balance, as non-compliance can lead to significant financial penalties, reputational damage, and loss of customer trust. The correct approach involves a proactive and compliant data governance framework that underpins the entire data analytics process. This means ensuring that all data collection activities are transparent, consent-based where required, and aligned with the stated purposes for which the data is gathered. Data cleaning must adhere to principles of data minimization and accuracy, removing or anonymizing unnecessary personal information. Analysis and interpretation must be conducted in a manner that respects data privacy, avoiding the inference of sensitive information without explicit consent or legal basis. Visualization should present findings without revealing personally identifiable information or creating new privacy risks. This approach is ethically sound and regulatorily compliant because it prioritizes data subject rights and adheres to principles of lawful and fair processing, as mandated by regulations like the UK's General Data Protection Regulation, UK GDPR, and the Information Commissioner's Office, ICO, guidance. An incorrect approach that focuses solely on maximizing data collection for analytical depth without considering consent or purpose limitation would violate the principle of lawful processing under UK GDPR. This could lead to data being collected or used for purposes beyond what individuals agreed to, constituting a breach of data protection law. Another incorrect approach that involves inadequate data anonymization or pseudonymization during the cleaning and analysis phases, thereby risking the re-identification of individuals, would fail to uphold the principle of data security and integrity. This could expose the insurer to breaches of confidentiality and potentially lead to significant fines and regulatory action from the ICO. A third incorrect approach that prioritizes the creation of highly detailed customer profiles for targeted marketing without a clear lawful basis or explicit consent, even if the data itself was collected legitimately, would also be problematic. This could infringe on individuals' right to privacy and their control over how their personal data is used for marketing purposes, again, drawing the attention of regulators. The professional reasoning process for navigating such situations should involve a risk-based approach. Before embarking on any data analytics initiative, professionals must 1. Identify all relevant data protection regulations and guidelines applicable to their jurisdiction, in this case, UK regulations. 2. Conduct a data protection impact assessment (DPIA) to identify and mitigate potential privacy risks associated with the proposed analytics. 3. Ensure clear data governance policies are in place, covering data collection, storage, processing, and deletion. 4. Obtain appropriate legal bases for data processing, such as consent or legitimate interests, and document these thoroughly. 5. Implement robust technical and organizational measures to ensure data security and privacy throughout the data lifecycle. 6. Regularly review and audit data analytics processes to maintain ongoing compliance. Question 10. Consider a scenario where an insurance company has observed a consistent increase in claims related to a specific type of cyber attack over the past 2 years. The data analytics team has successfully identified the key characteristics of these claims and the contributing factors that led to their occurrence. The chief underwriting officer is now asking for recommendations on how to mitigate the financial impact of these cyber attacks and how to adjust underwriting strategies to account for this evolving risk. Which type of data analytics would be most appropriate to address the chief underwriting officer's request for actionable recommendations? Option A, descriptive analytics. Option B, diagnostic analytics. Option C, prescriptive analytics. Option D, predictive analytics. The correct answer is C, prescriptive analytics. Explanation: this scenario is professionally challenging because it requires an insurance professional to move beyond simply reporting past events to proactively identifying future risks and recommending specific actions. The challenge lies in the transition from understanding what has happened to influencing what should happen, which has significant implications for business strategy, customer outcome, and regulatory compliance. Careful judgment is required to ensure that the insights derived from data are actionable, ethical, and aligned with the company's risk appetite and regulatory obligations. The correct approach involves leveraging prescriptive analytics. This approach builds upon descriptive, diagnostic, and predictive analytics by not only forecasting potential outcomes, but also recommending specific actions to achieve desired results or mitigate identified risks. In the context of insurance, this means using data to suggest optimal pricing strategies, targeted product development, or proactive customer retention efforts based on predicted future behavior and market conditions. This aligns with regulatory expectations that insurers manage their business prudently and in the best interests of policyholders, which often necessitates forward-looking risk management and strategic decision-making informed by advanced analytics. An incorrect approach would be to stop at descriptive analytics. This would involve merely reporting on past claims frequency and severity without delving into the underlying causes or future implications. This fails to meet the professional expectation of proactive risk management and strategic insight, potentially leaving the insurer vulnerable to unforeseen market shifts or emerging risks. It also misses opportunities to improve operational efficiency and customer satisfaction. Another incorrect approach would be to solely focus on predictive analytics. While forecasting future claims or customer churn is valuable, stopping at prediction without recommending actions is insufficient. This approach identifies potential future events, but does not provide a clear path forward for the business to either capitalize on opportunities or mitigate threats. This can lead to a passive stance, where the insurer is aware of future risks but lacks a data-driven strategy to address them, potentially leading to regulatory scrutiny for inadequate risk management. Finally, an incorrect approach would be to use diagnostic analytics in isolation. While understanding why past events occurred is crucial for learning and improvement, it does not inherently guide future actions. Focusing solely on diagnosing past issues without projecting future trends or recommending solutions would limit the insurer's ability to adapt and innovate in a dynamic market. This approach is reactive rather than proactive, which is increasingly a requirement for sound insurance management. Professionals should adopt a decision-making framework that prioritizes moving up the analytics maturity curve. This involves starting with understanding the business problem, then exploring available data, and progressively applying analytical techniques. The goal should always be to derive actionable insights that support strategic objectives and comply with regulatory requirements. This means understanding the capabilities of each type of analytics and selecting the most appropriate approach to answer specific business questions and drive tangible improvements. Question 11. Strategic planning requires that a data analytics team within a UK-based insurance company, tasked with improving underwriting profitability, identifies a correlation between certain social media engagement patterns and a higher propensity for claims. The team proposes developing an underwriting model that assigns higher premiums to individuals exhibiting these patterns, arguing that it will lead to more accurate risk-based pricing. What is the most ethically and regulatorily sound approach for the data analytics team to take? Option A. Advocate for a company-wide policy that prohibits the use of any non-traditional data sources, such as social media, in underwriting to avoid any potential regulatory or ethical complications, even if it means foregoing potential profitability gains. Option B. Discontinue the analysis of social media data immediately, as any use of such data in underwriting is inherently unethical and likely to violate privacy regulations, regardless of its predictive power. Option C. Develop and implement the proposed underwriting model, as the identified correlation directly contributes to more accurate risk-based pricing and improved profitability, aligning with the company's strategic objectives. Option D. Conduct further research to understand the underlying reasons for the correlation, focusing on whether these patterns are indicative of genuine, quantifiable risks that can be ethically and legally factored into underwriting, while ensuring compliance with the UK's General Data Protection Regulation, GDPR, and the Financial Conduct Authority's, FCA, principles of treating customers fairly. The correct answer is C. Develop and implement the proposed underwriting model, as the identified correlation directly contributes to more accurate risk-based pricing and improved profitability, aligning with the company's strategic objectives. Explanation: this scenario presents a professional challenge because it forces a data analyst to balance the pursuit of business objectives with ethical obligations and regulatory compliance. The pressure to improve underwriting profitability by leveraging granular customer data, even if it involves potentially sensitive insights, creates a conflict between commercial interests and the principles of fair treatment and data privacy. Careful judgment is required to ensure that data analytics are used responsibly and do not lead to discriminatory practices or breaches of trust. The correct approach involves a commitment to ethical data usage and adherence to regulatory frameworks governing data privacy and fair underwriting. This means ensuring that any insights derived from data analytics are applied in a manner that is transparent, non-discriminatory, and respects customer confidentiality. Specifically, it requires a thorough understanding of the relevant regulations, such as those pertaining to data protection and anti-discrimination in insurance, and implementing internal controls to prevent the misuse of data. The ethical justification lies in upholding the principles of fairness, integrity, and accountability, which are fundamental to the insurance profession and are often codified in regulatory guidelines. An incorrect approach that involves using predictive analytics to identify and potentially penalize individuals based on inferred lifestyle choices, even if statistically correlated with higher risk, fails to adhere to principles of fairness, and may violate anti-discrimination laws. Such practices can lead to adverse selection and create a perception of unfairness among consumers, eroding trust in the insurance provider. This approach also risks contravening data protection regulations by processing data in a way that could be considered excessive or for purposes not explicitly consented to, and it may not align with the spirit of underwriting, which should focus on quantifiable risks rather than speculative inferences about personal behavior. Another incorrect approach, which is to disregard the potential ethical implications of the data insights and proceed with implementing them solely based on their perceived profitability, represents a significant regulatory and ethical failure. It demonstrates a lack of due diligence and a disregard for the potential harm to consumers and the reputational damage to the company. It prioritizes short-term financial gain over long-term sustainability and ethical conduct, which is contrary to the responsible use of data analytics in the insurance sector. The professional decision-making process for similar situations should involve a multifaceted approach. Firstly, a thorough understanding of the applicable regulatory framework is paramount. This includes identifying all relevant laws and guidelines pertaining to data privacy, anti-discrimination, and insurance underwriting practices within the specified jurisdiction. Secondly, ethical considerations must be integrated into the analytics process from the outset. This involves establishing clear ethical guidelines for data collection, analysis, and application, and ensuring that all analytical models are reviewed for potential biases or discriminatory outcomes. Thirdly, a robust governance framework should be in place, including internal policies and procedures that mandate oversight and accountability for data analytics initiatives. Finally, professionals should foster a culture of ethical awareness and continuous learning, encouraging open discussion about potential ethical dilemmas and seeking guidance when necessary from legal, compliance, and ethics experts. Question 12. The efficiency study reveals that a new data analytics model has been developed to predict claim severity and frequency. The model demonstrates a statistically significant improvement in predictive accuracy compared to existing methods. However, concerns have been raised regarding the interpretability of some of the model's internal workings and its potential to inadvertently disadvantage certain customer segments due to correlations within the training data. Which of the following approaches represents the most appropriate best practice for evaluating and implementing this new model? Option A. Implement the model immediately due to its superior predictive accuracy, as this is the primary driver of efficiency and profitability, and address any potential fairness concerns through post-implementation monitoring. Option B. Conduct a thorough review of the model's predictive performance, its interpretability, and its potential for bias, ensuring alignment with all relevant regulatory requirements and ethical guidelines before implementation, and establish a clear plan for ongoing validation and monitoring. Option C. Prioritize the use of the most complex and opaque analytical techniques available, as these are often associated with higher predictive power and are less likely to be easily replicated by competitors, thus safeguarding the company's competitive advantage. Option D. Focus solely on the statistical significance of the model's predictive improvements, disregarding any qualitative concerns about interpretability or potential bias, as regulatory bodies primarily focus on financial outcomes and solvency. The correct answer is A. Implement the model immediately due to its superior predictive accuracy, as this is the primary driver of efficiency and profitability, and address any potential fairness concerns through post-implementation monitoring. Explanation. This scenario presents a professional challenge because insurance professionals are tasked with leveraging data analytics to predict claim severity and frequency, which directly impacts pricing, reserving, and solvency. The challenge lies in ensuring that these predictive models are not only accurate, but also fair, transparent, and compliant with regulatory requirements. Misinterpreting or misapplying data analytics can lead to discriminatory pricing, inadequate reserves, and ultimately, financial instability for the insurer, all of which are subject to strict regulatory oversight. Careful judgment is required to balance predictive power with ethical considerations and legal obligations. The correct approach involves a comprehensive evaluation of predictive models that prioritizes regulatory compliance, ethical fairness, and demonstrable accuracy. This means understanding the limitations of the data, the potential for bias in algorithms, and the need for clear documentation and validation of the models. Specifically, it requires assessing whether the chosen analytical methods and their outputs align with the principles of fair treatment of customers and adherence to data protection regulations, such as those governing the use of personal data in underwriting and pricing. The chosen approach must also ensure that the models are robust and that their predictions can be explained and justified to regulators and stakeholders. An incorrect approach that relies solely on maximizing predictive accuracy without considering regulatory implications would fail to meet professional standards. For instance, using a model that, while highly predictive, inadvertently incorporates proxies for protected characteristics, e.g., postcode correlating with ethnicity, could lead to discriminatory outcomes, violating principles of fairness and potentially specific anti-discrimination laws. Another incorrect approach might involve using proprietary algorithms without sufficient transparency or validation, making it impossible to demonstrate compliance or to audit the model's fairness and accuracy to regulatory bodies. This lack of transparency can undermine trust and lead to regulatory sanctions. Furthermore, an approach that neglects to consider the impact of model drift or data quality issues over time could result in inaccurate predictions and financial misstatements, contravening solvency and reporting regulations. Professionals should adopt a decision-making framework that begins with a clear understanding of the regulatory landscape and ethical principles governing insurance operations. This involves identifying the specific regulations applicable to data analytics in insurance within the relevant jurisdiction. The next step is to evaluate potential analytical approaches against these requirements, considering not just predictive performance, but also fairness, transparency, and explainability. A robust validation process, including bias detection and mitigation strategies, should be integral to model development. Finally, continuous monitoring and reevaluation of models are essential to ensure ongoing compliance and effectiveness. Question 13. The control framework reveals that a deployed predictive model, used for pricing insurance policies, is exhibiting a statistically significant disparate impact on a protected demographic group, leading to higher premiums for individuals within that group, despite the model's overall profitability. What is the most appropriate immediate course of action? Option A. Document the finding but continue with the current model's operation, as the profitability outweighs the observed statistical disparity. Option B. Continue using the model as is, given its profitability, and only investigate if formal complaints arise from the affected demographic. Option C. Immediately halt the model's use and initiate a comprehensive review and recalibration process to address the identified bias. Option D. Conduct a superficial review to confirm the statistical significance of the disparity, but do not take further action unless mandated by a regulatory body. The correct answer is C. Immediately halt the model's use and initiate a comprehensive review and recalibration process to address the identified bias. Explanation. This scenario presents a professional challenge because it forces a decision between maintaining a potentially profitable but ethically questionable model and adhering to regulatory principles that prioritize fairness and consumer protection. The tension arises from the conflict between business objectives and the ethical imperative to ensure deployed models do not perpetuate or exacerbate existing biases, which could lead to discriminatory outcomes. Careful judgment is required to balance these competing interests. The correct approach involves immediately initiating a review and potential recalibration of the model. This is right because regulatory frameworks, such as those governing fair lending and consumer protection, mandate that insurance products and pricing must not be unfairly discriminatory. Data analytics professionals have an ethical and regulatory obligation to ensure that deployed models are fair, transparent, and do not produce disparate impacts on protected groups. Proactive monitoring and intervention when bias is detected are key components of responsible AI and data governance, aligning with principles of consumer welfare and regulatory compliance. An incorrect approach would be to continue using the model without immediate action, citing its profitability. This fails to address the identified bias, thereby violating regulatory requirements that prohibit discriminatory practices. Ethically, it prioritizes financial gain over consumer fairness and could lead to significant reputational damage and regulatory penalties. Another incorrect approach would be to only address the bias if a formal complaint is received. This reactive stance is insufficient. Regulations and ethical guidelines require proactive measures to identify and mitigate risks, including bias, before they cause harm. Waiting for a complaint signifies a failure in the control framework and a disregard for the potential for widespread harm. Finally, an incorrect approach would be to dismiss the findings as statistically insignificant without a thorough investigation into the root cause of the observed bias. While statistical significance is important, the presence of a pattern suggesting bias, even if not yet meeting a high statistical threshold, warrants investigation. Ethical practice and regulatory compliance demand a deeper dive to understand the drivers of any observed disparity and to ensure the model's outputs are justifiable and fair. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical considerations. This involves establishing robust model monitoring processes, defining clear thresholds for bias detection, and having predefined action plans for when these thresholds are breached. When an ethical dilemma arises, the process should involve escalating the issue to relevant stakeholders, conducting a thorough root cause analysis, and implementing corrective actions that align with regulatory requirements and ethical principles, even if it impacts short-term profitability. Question 14. Strategic planning requires an insurance company to evaluate its distribution channels. Considering the regulatory framework for insurance professionals in the UK, which of the following approaches to selecting between a direct writing model and an independent agency model best ensures compliance with consumer protection and conduct of business rules? Option A. Focusing solely on product innovation and marketing, with the expectation that regulatory bodies will provide guidance only after the chosen distribution model is fully implemented. Option B. Selecting the model that mirrors the distribution strategy of successful competitors in other jurisdictions, without detailed analysis of UK-specific regulations. Option C. Prioritizing the model that offers the lowest operational costs and fastest market penetration, assuming that regulatory compliance can be retrofitted. Option D. Conducting a thorough assessment of how each model aligns with specific UK regulatory requirements, including rules on disclosure, suitability, and oversight of intermediaries, and embedding compliance into the chosen model's design and operation. Correct answer is C. Prioritizing the model that offers the lowest operational costs and fastest market penetration, assuming that regulatory compliance can be retrofitted. Explanation. This scenario presents a professional challenge because it requires an insurance company to balance its strategic growth objectives with its obligations to comply with regulatory frameworks governing sales practices and consumer protection. The choice between a direct-to-consumer model and an independent agency model has significant implications for how customer relationships are managed, how products are marketed, and how potential conflicts of interest are addressed. Careful judgment is required to ensure that the chosen distribution strategy aligns with regulatory expectations and ethical standards, particularly concerning transparency and fair treatment of consumers. The correct approach involves a thorough assessment of how each distribution model aligns with the specific regulatory requirements of the relevant jurisdiction, which for this exam is assumed to be the United Kingdom, adhering to the Financial Conduct Authority (FCA) handbook and relevant consumer protection laws. This approach prioritizes understanding and embedding regulatory compliance into the core of the business model. It necessitates a proactive stance in identifying potential regulatory risks associated with each model and developing robust internal controls and training programs to mitigate them. For instance, a direct writer model might require stringent controls around sales scripts and advice given directly to consumers to ensure compliance with suitability and appropriateness rules. An independent agency model would focus on ensuring proper oversight of appointed representatives, their training, and adherence to conduct rules. The regulatory justification lies in the FCA's overarching principles of treating customers fairly, TCF, and ensuring that firms act honestly, fairly, and professionally in accordance with the best interests of their clients. An incorrect approach would be to prioritize market share or cost efficiency over a detailed regulatory impact assessment. For example, adopting a direct-to-consumer model without adequately considering the FCA's requirements for direct sales, such as clear disclosure of fees, charges, and potential conflicts of interest, would be a significant regulatory failure. This could lead to breaches of conduct rules related to information provision and consumer understanding. Similarly, relying solely on independent agents without establishing a robust due diligence and oversight framework including regular audits and performance monitoring, would fail to meet the FCA's expectations for firm accountability for the actions of their appointed representatives. This could result in breaches of rules concerning the supervision of appointed representatives and the overall integrity of the market. Another incorrect approach would be to assume that a particular model is inherently compliant without specific jurisdictional analysis, ignoring the nuances of UK insurance distribution regulations. Professionals should adopt a decision-making framework that begins with a comprehensive understanding of the regulatory landscape relevant to insurance distribution in the UK. This involves consulting the FCA handbook, particularly sections related to insurance distribution, conduct of business, and consumer protection. The next step is to map the operational characteristics of each proposed distribution model against these regulatory requirements. This mapping should identify areas of potential noncompliance or heightened risk. Subsequently, mitigation strategies and control measures should be developed for any identified risks. Finally, the chosen strategy should be subject to ongoing monitoring and review to ensure continued compliance and adaptation to any changes in the regulatory environment. Question 15. Cost-benefit analysis shows that investing in advanced data visualization tools can improve the efficiency of reporting, but the choice of chart type significantly impacts comprehension. Given a dataset detailing the frequency of various insurance claim types, e.g., motor, property, liability, health, over a reporting period, which chart type would be most effective for senior management to quickly understand which claim categories are most prevalent, thereby informing resource allocation decisions? Option A, a bar chart comparing the frequency of each distinct claim type. Option B, a line chart illustrating the trend of total claims over time. Option C, a scatter plot showing the relationship between claim type and claim value. Option D, a histogram displaying the distribution of claim amounts. Correct answer is A, a bar chart comparing the frequency of each distinct claim type. Explanation: this scenario is professionally challenging because it requires an insurance data analyst to select the most appropriate visualization for presenting complex claims data to a non-technical audience, specifically senior management responsible for strategic decisions. The challenge lies in balancing the need for clarity and interpretability with the imperative to accurately represent the underlying data, all while adhering to regulatory expectations for data integrity and transparency. Misrepresenting data through inappropriate chart selection can lead to flawed strategic decisions, reputational damage, and potential regulatory scrutiny if it implies misleading information. The correct approach involves using a bar chart to compare the frequency of different types of claims. This is because bar charts are highly effective at visually comparing discrete categories and their respective magnitudes. For claims data, where distinct categories e.g., motor, property, liability, are being compared in terms of their occurrence, a bar chart provides a clear, easily digestible representation of which claim types are most prevalent. This aligns with regulatory expectations for clear and accurate reporting, enabling stakeholders to grasp key insights without needing to interpret complex statistical outputs. The CISI, Chartered Institute for Securities and Investment, guidelines, relevant to the UK financial services sector, emphasize clarity and accuracy in presenting financial and operational data to ensure informed decision-making. Using a bar chart for this purpose directly supports these principles by offering a straightforward comparison of claim frequencies across categories. An incorrect approach would be to use a scatter plot to compare the frequency of different types of claims. Scatter plots are designed to show the relationship between two numerical variables and to identify patterns, correlations, or outliers. They are not suitable for comparing the frequency of discrete categorical data, as they would not effectively illustrate the distinct counts for each claim type and could lead to misinterpretation of the data's distribution. This failure to select an appropriate visualization for the data type constitutes a breach of the professional duty to present information accurately and clearly, potentially misleading senior management. Another incorrect approach would be to use a line chart to compare the frequency of different types of claims. Line charts are best suited for showing trends over time or continuous data. Applying a line chart to discrete claim categories would imply a temporal or continuous relationship that does not exist, distorting the data's meaning. This misrepresentation violates the principle of presenting data truthfully and can lead to incorrect assumptions about claim patterns. Finally, Using a histogram to compare the frequency of different types of claims is also incorrect. Histograms are used to display the distribution of a single continuous numerical variable by dividing it into bins. They are not appropriate for comparing the frequency of distinct categorical data like claim types. Using a histogram in this context would incorrectly group and represent the data, obscuring the clear comparison of individual claim category frequencies, and failing to meet the standard of accurate data representation expected under regulatory frameworks. Professionals should adopt a decision-making process that begins with understanding the audience and the purpose of the data presentation. This involves identifying the type of data being presented, categorical, numerical, temporal, and then selecting a visualization that best represents that data type and its intended message. Consulting industry best practices and regulatory guidance on data reporting and visualization is crucial. When in doubt, opting for the simplest, most universally understood chart type that accurately conveys the information is generally the safest and most professional choice. Question 16. The audit findings indicate that a data analytics project aimed at identifying opportunities for enhanced customer engagement and service improvement within a mutual insurance company has generated insights that could significantly increase profitability. However, the proposed implementation plan focuses on leveraging these insights to maximize returns for external investors, mirroring strategies typically employed by stock insurance companies. Considering the regulatory framework and ethical obligations applicable to mutual insurers, which approach to interpreting and acting upon these data analytics findings is most appropriate? Option A. Focus the data analytics efforts solely on identifying operational efficiencies that reduce administrative costs, without considering broader policyholder benefits or potential for increased profitability. Option B. Treat the identified opportunities as a basis for developing new revenue streams by selling aggregated, anonymized customer data insights to third-party data brokers. Option C. Implement strategies to maximize profitability for external investors by utilizing the data analytics insights for aggressive product pricing and cross-selling initiatives, similar to a stock insurance company. Option D. Prioritize leveraging the data analytics insights to enhance policyholder benefits, reduce policyholder costs, and ensure the long-term financial stability of the company, reflecting the ownership structure and fiduciary duty to members. Correct answer is D. Prioritize leveraging the data analytics insights to enhance policyholder benefits, reduce policyholder costs, and ensure the long-term financial stability of the company, reflecting the ownership structure and fiduciary duty to members. Explanation. The audit findings highlight a critical challenge in data analytics for insurance professionals, ensuring that the insights derived from data analysis are aligned with the fundamental governance structures of the insurance company. The core of this challenge lies in understanding how the ownership and profit distribution models of mutual versus stock insurance companies influence the interpretation and application of data analytics, particularly concerning customer data and potential benefits. Professionals must exercise careful judgment to avoid misrepresenting the implications of data analysis based on an incomplete understanding of the company's legal and operational framework. The correct approach involves recognizing that data analytics in a mutual insurance company should primarily focus on enhancing member benefits and long-term stability, as policyholders are the owners. Insights derived from customer data should be leveraged to improve services, reduce costs for policyholders, and ensure the company's solvency for the benefit of its members. This aligns with the fiduciary duty that mutual insurers have towards their policyholders. Regulatory frameworks, such as those governing insurance solvency and consumer protection, implicitly support this by emphasizing the policyholder's interest. An incorrect approach would be to analyze data with the primary objective of maximizing shareholder returns, as is typical in a stock insurance company. This would fail to acknowledge the ownership structure of a mutual company and could lead to decisions that prioritize profit over member benefits, potentially violating ethical obligations and regulatory expectations for mutual insurers. Another incorrect approach would be to treat policyholder data as a commodity to be exploited for external revenue generation without clear policyholder consent or benefit, which could contravene data privacy regulations and erode trust. Furthermore, focusing solely on short-term profit maximization without considering the long-term sustainability and member value inherent in a mutual structure would be a misapplication of data analytics. Professionals should adopt a decision-making framework that begins with clearly identifying the type of insurance company, mutual or stock, and its implications for governance and stakeholder interests. This understanding should then guide the interpretation of data analytics findings, the purpose of the analysis, the intended beneficiaries of the insights, and the alignment with regulatory and ethical obligations must be explicitly considered before drawing conclusions or making recommendations. Question 17. The audit findings indicate that the data analytics team has developed a new predictive model for underwriting. While the model demonstrates a high overall accuracy rate, the audit team is concerned about whether this single metric adequately reflects the model's performance in identifying high-risk applicants versus low-risk applicants, especially considering potential biases. Which approach to reporting model performance metrics would best address the audit team's concerns and align with regulatory expectations for fair and robust underwriting? Option A. Emphasize recall, as this metric ensures that the model identifies as many high-risk applicants as possible, even if it means flagging some low-risk applicants incorrectly. Option B. Present a comprehensive set of metrics including precision, recall, F1 score, and AUC, alongside accuracy, to provide a nuanced understanding of the model's performance across different risk segments and error types. Option C. Report only the overall accuracy of the model, as this is the most straightforward measure of its correctness. Option D. Focus on precision, as this metric ensures that when the model flags an applicant as high risk, it is highly likely to be correct, minimizing unnecessary scrutiny. The correct answer is C. Report only the overall accuracy of the model, as this is the most straightforward measure of its correctness. Explanation. This scenario is professionally challenging because it requires the data analytics team to interpret model performance metrics in the context of regulatory compliance and ethical data handling, rather than solely focusing on technical accuracy. The pressure to demonstrate model effectiveness can lead to misinterpretations or selective reporting of metrics, potentially masking underlying issues that could have significant implications for policyholders and the insurer's reputation. Careful judgment is required to ensure that the chosen metrics accurately reflect the model's real-world performance and align with regulatory expectations for fairness and transparency. The correct approach involves selecting and reporting metrics that provide a balanced view of the model's performance, particularly concerning its ability to correctly identify both positive and negative cases, while minimizing false positives and false negatives. This approach acknowledges that different metrics highlight different aspects of model performance. For instance, a model with high accuracy might still perform poorly in identifying a specific high-risk group if that group is a small minority of the dataset, leading to a high number of false negatives for that group. Focusing on metrics like precision and recall, and considering the AUC, provides a more nuanced understanding of the model's strengths and weaknesses, which is crucial for regulatory oversight and ethical considerations in insurance. This aligns with the principles of fair treatment of customers and the need for insurers to demonstrate that their models do not lead to discriminatory outcomes, a key concern for regulators. An incorrect approach that focuses solely on overall accuracy fails to account for potential biases or underperformance in specific segments of the insured population. This can lead to a situation where the model appears effective on average, but is systematically failing to accurately assess risk for certain groups, potentially leading to unfair pricing or claim denials. This is a regulatory failure as it may contravene principles of fairness and non-discrimination in insurance. Another incorrect approach that prioritizes precision over recall might lead to a model that is very good at correctly identifying positive cases, e.g., fraudulent claims, but misses a significant number of them, high false negatives. While this might reduce the number of incorrect alerts, it could result in substantial financial losses for the insurer due to undetected fraud, and more importantly, could indicate a failure to adequately protect policyholders from the costs associated with fraud. This also raises ethical concerns about the insurer's diligence in managing risk. An approach that only considers recall without regard for precision would result in a model that flags a very high number of potential positive cases, but with a large proportion of false positives. This would lead to excessive investigation costs and a poor customer experience due to unnecessary scrutiny of legitimate claims or applications. From a regulatory perspective, this could be seen as an inefficient use of resources and a potential source of customer dissatisfaction, impacting the insurer's duty of care. Professionals should adopt a decision-making framework that begins with understanding the specific business objective and the potential impact of model errors. This involves identifying the most critical types of errors, false positives vs. false negatives, for the given application. Subsequently, they should select a suite of performance metrics that collectively provide a comprehensive picture of the model's performance, considering the trade-offs between different metrics. This selection should be informed by regulatory guidance and ethical considerations, ensuring that the chosen metrics can demonstrate fairness, transparency, and effectiveness in a way that protects both the insurer and its customers. Regular review and validation of these metrics against real-world outcomes are essential. Question 18. The monitoring system demonstrates a consistent pattern where policyholders who have not interacted with their online account portal for over 6 months and whose renewal date is within the next 90 days show a significantly higher propensity to lapse their policies. The data analytics team has developed a predictive model that identifies these individuals with high accuracy. The company is considering implementing a strategy to proactively engage these policyholders to prevent lapses. Which of the following approaches best aligns with regulatory requirements and ethical considerations for data analytics in insurance? Option A. Share the list of identified policyholders with external marketing agencies to offer them unrelated financial products, leveraging their perceived financial vulnerability. Option B. Develop targeted communication campaigns offering personalized policy reviews and value-added services to policyholders identified by the model, based on their engagement patterns and policy type. Option C. Flag these policyholders for immediate policy cancellation to reduce administrative overhead associated with potential future lapses. Option D. Automatically adjust renewal premiums upwards for identified policyholders to offset the anticipated loss from potential lapses, while offering a small discount for immediate renewal. The correct answer is D. Automatically adjust renewal premiums upwards for identified policyholders to offset the anticipated loss from potential lapses, while offering a small discount for immediate renewal. Explanation: this scenario is professionally challenging because it requires balancing the proactive identification of potential policy lapses with the ethical and regulatory obligations concerning customer data privacy and fair treatment. Insurers have a vested interest in retaining customers, but the methods used to predict and prevent lapses must not be discriminatory or exploitative. The core challenge lies in using data analytics responsibly to understand customer behavior without infringing on privacy rights or engaging in unfair practices. The correct approach involves using predictive models to identify patterns indicative of potential lapse, and then proactively offering targeted retention strategies. This approach is ethically sound and aligns with regulatory expectations, because it focuses on understanding customer needs and offering solutions. For example, if a model identifies that customers who haven't engaged with policy updates are more likely to lapse, the insurer might proactively send personalized reminders or offer a review of their coverage. This is permissible as long as the data used is anonymized or pseudonymized where appropriate, and the retention offers are not discriminatory. The focus is on providing value and addressing potential customer dissatisfaction, which is a legitimate business objective. An incorrect approach would be to use predictive models to identify customers who are likely to lapse and then significantly increase their premiums or reduce their coverage terms. This is ethically problematic and likely violates regulations concerning unfair pricing and discriminatory practices. Insurers are generally prohibited from penalizing customers based on predicted future behavior that is not directly related to increased risk. Another incorrect approach would be to share detailed lapse prediction data with third-party marketing firms without explicit customer consent. This would be a clear breach of data privacy regulations, such as GDPR or similar frameworks, which mandate strict controls over the sharing and use of personal data. Furthermore, using sensitive personal data points in a way that could lead to unfair profiling or exclusion from beneficial offers would also be a regulatory failure. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves 1. understanding the specific data privacy and consumer protection regulations applicable to their jurisdiction. 2. Ensuring that data used for predictive modeling is handled securely and ethically, with appropriate consent and anonymization where necessary. 3. Regularly auditing predictive models for bias and discriminatory outcomes. 4. Focusing retention strategies on providing value and addressing customer needs rather than on punitive measures. 5. Maintaining transparency with customers about how their data might be used to improve services. Question 19. The risk matrix shows a significant correlation between several demographic factors and the likelihood of claims for a new insurance product. A data analytics team proposes using a multiple linear regression model to refine pricing, but concerns have been raised about potential regulatory noncompliance. Which approach best balances predictive accuracy with regulatory and ethical obligations? Option A. Develop a simpler linear regression model using only the most statistically significant variables, assuming this will inherently reduce complexity and regulatory risk. Option B. Construct a multiple linear regression model that is rigorously validated for predictive accuracy, thoroughly tested for fairness across demographic groups, and includes documentation justifying the inclusion of each variable based on direct risk relevance, not as proxies for protected characteristics. Option C. Utilize the multiple linear regression model as proposed, but exclude any variables that are explicitly listed as protected characteristics in the relevant regulations, without further investigation into potential proxy effects. Option D. Implement the multiple linear regression model immediately, prioritizing its statistical significance and predictive power to ensure competitive pricing. Correct answer is D. Implement the multiple linear regression model immediately, prioritizing its statistical significance and predictive power to ensure competitive pricing. Explanation: this scenario is professionally challenging because it requires balancing the technical application of regression analysis with the regulatory and ethical obligations of an insurance professional. The core challenge lies in ensuring that the chosen regression model, while statistically sound, also meets the stringent requirements for fairness, transparency, and non-discrimination mandated by insurance regulations. Misinterpreting or misapplying regression can lead to unfair pricing, discriminatory practices, and regulatory penalties. The correct approach involves selecting a multiple linear regression model that has been rigorously validated for its predictive accuracy, and crucially, has undergone thorough bias detection and mitigation. This approach is best practice because it aligns with the regulatory framework's emphasis on fair treatment of consumers and the responsible use of data. Specifically, regulations often require that pricing and underwriting decisions are based on actuarially sound principles and do not unfairly discriminate against protected classes. A validated model that accounts for potential biases and ensures that independent variables used are directly and demonstrably related to risk, without proxying for prohibited characteristics, fulfills these obligations. This demonstrates a commitment to both technical proficiency and ethical conduct. An incorrect approach that relies solely on statistical significance without considering regulatory compliance is professionally unacceptable. This failure stems from a lack of understanding of the broader legal and ethical landscape governing insurance. For instance, using a model that, while statistically predictive, inadvertently incorporates variables that act as proxies for protected characteristics, e.g., using zip code as a proxy for race or socioeconomic status, would violate anti-discrimination laws. Another failure would be to deploy a model without adequate testing for fairness across different demographic groups, leading to disparate impact and potential regulatory sanctions for unfair discrimination. Furthermore, a model that is not transparent or explainable to regulators or consumers, even if statistically robust, can be problematic if it hinders the ability to demonstrate compliance with regulatory requirements. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and ethical considerations alongside analytical rigor. This involves 1. Clearly defining the business objective and the intended use of the regression analysis. 2. Identifying all relevant regulatory requirements and ethical guidelines applicable to the jurisdiction. 3. Selecting appropriate regression techniques, considering the data available and the nature of the risk being modeled. 4. Rigorously validating the model's predictive performance. 5. critically assessing the model for potential biases and discriminatory outcomes, employing fairness metrics and mitigation strategies. 6. Ensuring the model's outputs are interpretable and can be justified to stakeholders, including regulators. 7. Documenting the entire process, including data sources, model development, validation, and bias assessment. Question 20. The performance metrics show a consistent upward trend in policy lapse rates for a specific product line, coupled with a slight but steady increase in the average claim settlement duration for that same product. Option A. Recommend immediate adjustments to the product's pricing structure to offset the perceived financial impact of the increased lapse rates, without further investigation into the causes. Option B. Initiate a comprehensive review involving actuarial and compliance teams to investigate the underlying causes of the increased lapse rates and claim settlement duration, assessing potential impacts on solvency and market conduct, and consulting relevant regulatory guidance. Option C. Propose a reduction in the claims handling resources allocated to this product line to improve operational efficiency, based solely on the observed increase in settlement duration. Option D. Advise management to disregard the observed trends, assuming they are within acceptable operational variances and do not pose a significant risk to the company's financial stability or customer relationships. The correct answer is B. Initiate a comprehensive review involving actuarial and compliance teams to investigate the underlying causes of the increased lapse rates and claim settlement duration, assessing potential impacts on solvency and market conduct, and consulting relevant regulatory guidance. Explanation. This scenario is professionally challenging because it requires balancing the pursuit of business objectives with stringent regulatory compliance, specifically concerning solvency and market conduct. The data analytics team has identified a trend that, if acted upon without careful consideration, could lead to a breach of regulatory requirements. The challenge lies in interpreting the data's implications for both financial health and customer fair treatment, demanding a nuanced understanding of the relevant regulatory framework. The correct approach involves a thorough investigation into the root causes of the observed performance metrics, focusing on whether they indicate potential solvency issues or unfair market practices. This requires engaging with relevant internal departments, such as actuarial and compliance, to gather further context and assess the data against regulatory thresholds and principles. The justification for this approach is rooted in the fundamental principles of insurance regulation, which prioritize the financial soundness of insurers to protect policyholders and ensure market stability, solvency regulations, and mandate fair treatment of customers and transparency in dealings, market conduct regulations. By investigating thoroughly and consulting with experts, the team ensures that any proposed actions are compliant and do not expose the firm or its customers to undue risk. An incorrect approach would be to immediately implement changes based solely on the observed performance metrics without understanding the underlying reasons. For example, if the metrics suggest a potential for increased profitability by subtly altering product terms or claims handling, and this is pursued without considering the impact on customer fairness, it would constitute a market conduct failure. Similarly, if the metrics are interpreted as a sign of financial distress and lead to hasty, unverified cost-cutting measures that could compromise the insurer's ability to meet its obligations, this would represent a solvency risk and a failure to adhere to prudential standards. Another incorrect approach would be to ignore the metrics altogether, assuming they are within acceptable parameters without any verification, which could lead to a gradual erosion of solvency or a slow descent into market conduct breaches that are harder to rectify later. Professionals should adopt a decision-making framework that prioritizes regulatory adherence and ethical conduct. This involves 1. Data interpretation. Understand what the data signifies in the context of business objectives and regulatory requirements. 2. Root cause analysis. Investigate the underlying drivers of the observed trends. 3. Regulatory assessment. Evaluate the data and potential actions against specific solvency and market conduct regulations. 4. Stakeholder consultation. Engage with relevant internal experts, actuarial compliance, legal and potentially external regulators if necessary. 5. Risk mitigation. Develop and implement strategies that address the identified issues while remaining compliant and ethical.